Hey guys, welcome back. Chapter one, managerial accounting and cost concepts. So, just really sort of talking through this the chapter from a higher level, and there's going to be lectures that go through it in more detail. I want to give you a broad overview, sort of help you understand the concepts, the why, and then I'm going to be sending some resources that'll help you understand the details and additional resources that'll help you understand more of a full understanding. Again, my philosophy is that when you hear it from different ways and different viewpoints, you're going to come together and get a really good understanding of this. I've seen this work in the past, and I feel like it's a successful way that keeps everything a little fresher for you. And when you hear it from different perspectives in different ways, it just broadens your understanding. And so that's why I prefer this method of instruction. I hope this helps you. I hope you find it beneficial. You can always call. You can always set up time to talk. If there's something you're not understanding, get in touch with me. I'm here to help. So I'm trying to design this in the most effective way possible for you guys. And again, it's hard material, but and you got to put some ownership on yourself in terms of really getting in and digging in my experience through online classrooms, you get out of them what you put into them. So I sort of want to build that as a preface, but I'm here to help, and if you need that help, that's what I'm here for. So um, just talking through managerial accounting cost concepts. So managerial accounting, I'm going to read sort of a definition. It focuses on providing financial and non-financial information to internal decision makers, such as managers, for the purposes of planning, controlling, and decision making. So it's going to allow managers to achieve their organizational goals and support their strategic and operational decisions. The big thing about managerial accounting, uh, unlike financial accounting, this is not GAAP. This is just what information is relevant to our business that helps us to operate more efficiently, more effectively. How do we make better decisions? I had a boss once. I was at Colonial Pipeline, largest gasoline pipeline in the nation, and I was there for 9 years. And I remember, like our president, he would go up and testify before Congress all the time, talk to them about different things. Just high level people. One of our presidents was selected by George W. Bush to get the pipelines up and running again after Kuwait and the invasion of Iraq and all of that. So, very high level people that we worked with, and but I remember him saying, in fact, my CFO. That's another fun fact. We had a situation room, a red phone that went right to the White House. It was that kind of business. It handled 90% of the gasoline movements in its operating area, which was a pipeline from Houston, Texas, all the way to New York. So it went through Washington and all of that. And so we were critical infrastructure. It handled the whole East Coast. 90% of the gasoline moved through us. And and our CFO, he was actually up for the job at Enron with Kenneth Lay. A lot of you guys have heard of Enron through the debacle and Sarbanes-Oxley. He was actually um, in running to be the president before Kenneth Lay beat him out. They made him, Rod Gray, a president of another particular area. And then he ended up coming over to Colonial, one of the smartest people I've worked with, just a brilliant guy. It was obviously the right decision for him. He was an ethical guy, never saw anything that indicated he wasn't. And so I think it worked out for everybody involved in that situation, but brilliant guy. And so, that I had one of my uh, presidents at the time. He told us, he said, there is a mathematical answer for every decision you make. And that really stayed with me. That there's a mathematical decision in business for every decision you make. You should be able to justify every decision you make mathematically. There should be support for it. There should be a reason that you did something. And so that's part of what managerial accounting is. It's gathering the relevant information. So when we talk about cost objects, this is anything for which costs are measured and assigned, like products or departments or projects. How do we track our costs? If it's for a house, say you're a builder, all of those costs need to be tracked according to the lot, according to the property you're building. Um, some are relevant, some are not. Some need to be spread out against all the lots in a subdivision. Some don't. But you need to consider what you're tracking accordingly. There's different types of costs. There's direct costs. These are costs that can be easily and conveniently traced to a specific cost object, like direct materials, direct labor. We know that we're using certain builders to put the roof on. We know we're buying shingles for the roof. We know we're buying lumber for the house. We get that. Then there's indirect costs. These are a little harder to track. These can't be as easily tracked to a specific cost or lot. They're more like manufacturing overhead. Well, there's the whole builder's office that exists that we've got to figure out how to allocate. Some people work indirectly on things, some don't. What about the procurement department who's uh, buying all this stuff? How is that cost allocated among the profitability of the firm? Let's say that you have some cleanup going on in a particular subdivision. Well, is it cleanup for four specific lots? Does it need to be allocated among those four specific lots? Or does it need to be allocated across the whole subdivision? Maybe it's something like the pool. Well, we need to sort of allocate that cost in the subdivision. We need to figure out different ways of tracking things. So all that's important. What about cost classifications for manufacturing companies? So for manufacturing companies, there's direct materials. These are raw materials that end up becoming an integral part of the finished product. There's direct labor. These are labor costs that can be easily traced to individual units of product. There's also manufacturing overhead. All the manufacturing, all of the costs of manufacturing except direct materials and direct labor. This is like depreciation of factory equipment or factory utilities. But your direct materials, that's your sticks and bricks. That's the bricks that you're putting on a house, the lumber you're putting in, the direct cost. That's pretty easy to figure out for materials. The direct labor, who's doing the work, that's pretty easy to figure out too. All of that is easy to identify. But the overhead, that's where you have to look at everything else that's not as clear and cut. There's also non-manufacturing cost. Um, these are costs incurred to secure customer orders or deliver the products, some selling cost. You have to have certain costs like the realtor commissions. They are not manufacturing, they are part of the cost of doing business. You have to have a realtor out there to sell your property after you build it. There's administrative costs. There's costs with the general management, office salaries, the legal expenses. All of that is administrative type costs. There are cost classifications for preparing financial statements. So there are product costs. These are costs that are assigned to goods that were either purchased or manufactured for resale, like inventory cost. Um, Included in that is your cost of goods sold on the income statement. You guys understand like inventory. It's raw materials that you buy. This is all the categories of inventory that show up on your balance sheet. So it starts out with raw materials. All of that moves down into work in process. From work in process, it comes down to finished goods. Once it's a finished house, you sell it, it goes over, it leaves the balance sheet and it goes into the income statement as a cost of goods sold. Your revenue, the sales price, let's say concessions, minus that cost of goods sold is going to give you your gross profit. Then your gross profit, you'll deduct your other administrative kind of costs and things like that, that will end up giving you your net profit. Okay, but you got to figure out your profit first. That's what the revenue uh, minus your cost of goods sold will give you your gross profit, and that's an important number to your metric. That metric allows you to pay for all your other costs. You got to figure out what your gross margin is, and then you got to figure out your net margin. You need to look at both things. But there's product cost. That's the product cost. How much the product itself costs. There's also period cost. That's like January, February, March, April, May, June. The period, or it could be a quarter or a year. But the period costs are more time sensitive. These are costs that are expense in the period incurred. Selling administrative expenses, like you pay your secretary the same thing every month, and that's a cost. Um, let's say you have an insurance. There's prepaid expenses. Maybe you guys remember that. It goes as an asset on your balance sheet as a prepaid expense, maybe for $3,000 for the year, or let's say 12,000 for the year. Math easier. So we'll take 12,000. So you expense 1,000 a month, and that's how that is tracked. So it leaves the balance sheet and it goes to the income statement when you use it, and that's a period cost. Your rent, that would be a period cost. Um, but these appear on the income statement as operating expenses. There's also cost classifications for predicting cost behavior. Um, so when we talk about what cost behavior is, these are how costs respond to changes in the level of business activity. They vary based on the level of activity. So there are different kinds of costs. There's variable costs, there's fixed costs, and there's mixed costs. So the variable costs are costs that are going to change in direct proportion in the changes of activity levels. Sort of, you know, raw materials. The more you build, the more raw materials cost. They go up in direct proportion with what you're building, or they go down in direct proportion with what you're building. Fixed costs. These costs stay the same regardless of activity level. Rent is always rent. Salaries that aren't variable are always salaries. You have to pay them every month. Um, there's also mixed cost, and these are costs that have different variable and fixed components, like a utility bill that has a base fee with a usage charge. So there's a base charge for having utilities, but then you get charged a certain amount based on how much you use every month. Um, there is also cost classifications for decision making. You gotta have relevant cost, you have irrelevant costs, you have opportunity cost, and incremental or differential cost. So when we talk about relevant costs, these are costs that will change as a result of a specific decision. You have irrelevant costs. These costs aren't impacted by the decision. It's like a sunk cost. You know, when something happened in the past, you've already spent the money. That's not impacting your future decision. People miss that all the time. Your decision to buy that new software system is only the cost of the new software system and the benefits accordingly. But the old software system that you just bought last year that's no good anymore, that's the sunk cost. You're not using that to make your current decision. So that's important. You've got relevant costs. These costs are impacted when you buy a new software system. Your fee goes from 3,000 a month to 4,000 a month. So you got $1,000 a month extra, but you're already paying the 3,000 a month. You're not worried about that. You're worried about the new cost, that differential, that incremental or different cost. That's what matters. It's when you pick one alternative over another that is a relevant cost. Um, that's what opportunity cost. Opportunity cost is the potential benefit lost when one alternative is chosen over another. So people mix this up. When I ask, what's your opportunity cost for being in school? Some people will say, well, I could be sleeping, I could be working, I could be investing, use that money to invest different places. No, all of those are not opportunity costs. Now, each of those could be a different alternative cost for a different person. But when you look at opportunity cost, what you're saying is the next best alternative. So if I've got choice A here, I say I have $1,000 to spend. I only have $1,000 to spend. If I have 10 alternatives and they cost $1,000 each, I don't have 10,000 to spend. I have 1,000 to spend. So I rank them in order of importance, and then that $1,000 that I could be investing with, that $1,000 now is what I spent for school. I only had 1,000 to invest or 1,000 to go to school. I chose school over investing. So that would be the order of importance right there. but I didn't have $10,000. So it's the next best alternative. That's what you're giving up. So when we're talking about different cost classifications for different purposes, we want to assign costs. We want to focus on direct and indirect. That's important. When we're figuring out what something costs, what's the direct cost, what's the indirect cost? We want to look at decision making. We want to emphasize or put our emphasis on relevant or irrelevant or opportunity costs. What are these costs that we're actually dealing with? How relevant are they? Are they irrelevant? What's our opportunity cost for making a decision? We want to look at controlling cost. We want to focus on understanding the fixed and the variable and the mixed costs for any budgeting and forecasting. If we've got a fixed cost of 1,000, but then based on a certain amount of energy usage, that starts to increase. Well, we need to consider that incremental change in our decision. There's also financial reporting. This is the distinction between product and period costs for compliance with accounting standards. So sometimes we have to look at whether it's an actual product cost or it's a period cost, and we need to consider that impact. Um, Overall, just in summary, there's managerial accounting, which provides tailored cost information for internal decision making. There's cost classifications that vary depending on the purpose, financial reporting, budgeting, decision making. There's also, we need to understand the cost behavior is crucial in predicting how costs change with activity levels. And different cost concepts serve different managerial needs and contribute to informed strategic decisions. So hopefully that gives you sort of a broad overview of chapter one. These overviews, I promise, aren't going to be this long every time. I'm going to sort of set up the expectation of what we're looking at this time. And they should be sort of a shorter recap where you can get some relevant information regarding the chapter. And then the chapters I attach within the lectures are going to be a little more detailed, a little more refined. Um, I'm going to give you additional resources because I don't know that they always cover things the way I want them to cover them, and additional resources there. And then I'm here. If you have questions, reach out, call, text. Let's set up a time to talk. If you're not understanding something, let me know. I'm here to help. Hope you guys have a great week, and let me know if you have anything you need from me. Talk to you guys soon.